Well, the emerging market sell-off of the last couple of weeks has really exposed economies, and some commentators even saying that the emerging market sell-off could really become a big and scary correction. Lots of people are talking about bubbles, not only, of course, in emerging markets, but also in developed markets as well. More narrowly, it's what effects does China's cooling down have on South Africa? So China being our BFF, of course, our best friends from the Far East, and other emerging markets. This is Tonight. I'm Bruce Whitfield. Tonight I'm joined in studio by Mohammed Nalla, Head of Strategic Research at Nedbank Capital, and Worth W. Wray. He's the co-author of A Great Leap Forward, ? And a global macro strategist. He joins us from Houston, Texas via Skype. Worth, it's good to have you with us. Mohammed, you too, just for the record. Give me a sense, please, of the China story, because there is so much information, there is so much misinformation. Give us the big China picture, please, as to what's going on.
So China is going through a major adjustment, and it's difficult to know what it's seeing as growing pains or whether its growth model is exhausted and at the end of its rope. So China has grown for the last 30 years, largely as a result of top-down, command-oriented policies. It's been largely export and investment-driven growth. What's important to keep in mind about that investment-driven growth is that it's added up to significant debt growth over the years. A lot of this is driven by credit and a financial system that favors state-owned enterprises over households. So it's kept consumption low, investment high. Over the last 15 years, you've seen China's debt load go from $2 trillion in the private sector to $28 trillion in the private sector, with over 17 of that coming since the global financial crisis. And if you think about that rapid burst of credit growth, historically, quick binges like that in the credit market tend to lead to large amounts of bad debt. Every economy that's ever experienced rapid growth like this in a 5-year period, they've all ended in hard landings. In China, we don't know how big the problem is. We don't know if it's a mountain or a molehill. But the non-performing loan ratio, even though it's officially reported at 1.5%, may be closer to even 20%. That means China has to adjust now or risk running into the wall later. For South Africa, this is going to have profound implications. What we're looking at in China is that even if the Chinese do everything right, their export or their import demand mix is going to change. Their appetite for commodities is falling. Their appetite for platinum group metals, for example, is going to fall. Now, there's a lot of people that look to a consumer story in China, say we're going to need a lot of catalytic converters for automobiles as the middle class consumer rises up. But I have to tell you, in the short term, retail spending is up a little bit here on the stock market boom, but the longer medium-term impact of the consumer is still very much in question. So China's going through this adjustment. We will see what happens internally. It may be a big risk for the world, or it may just be a moderate risk for the rest of the world commodity producers in the forefront.
Worth, thank you for taking a breath. One gets the impression, or one is told, or one reads the Reuters and Bloomberg feeds, and one gets the sense that the slowdown is being deliberately engineered by China because they know the risks and the problems that you are portraying for us this evening, and so we should just ride this particular wave.
You know, goodness, I hope so. I hope that Beijing is acknowledging behind closed doors that they cannot try to maintain these high levels of growth. You know, their official target is about 7%, and there's an inherent contradiction in trying to achieve 7% growth while trying to also rebalance the economy to a more sustainable, healthy growth model. There's a lot of people that think that Chinese GDP numbers are dramatically overstated from where they are in truth, and that actually would be a good thing. If China was only growing at 3–4% right now, I would be a lot more optimistic about their future growth possibility. So I hope they're embracing it, because if they're not, the risk is that there could be a sudden shock and collapse down the road. Now, that's not my base case.
Worth W. Wray, we do need to give Mohammed Nalla a turn because he can reach me, and the line is also just that little bit dodge. Worth W. Wray is with us from Houston in Texas. You know him well, Worth W. Wray, that is, not the Chinese government official. Is he overly bearish on China?
So, I mean, Worth's co-authored this book. It's fairly balanced. So they've got some good news stories. They've got some bad news stories in there. The fact of the matter is that we don't really know. And the reason why we don't really know is that there's a fair degree of opacity around the Chinese data that they actually give us. On that basis, something that I think is fairly clear for emerging markets, for commodity producers like South Africa, is that this adjustment, whether it's slow or fast, is going to come with some growing pains. It's going to come with some painful consequences. And unfortunately, even assuming that China is successful in terms of skewing away from this infrastructure, commodity-heavy type of growth model, if they can skew towards a consumption-led growth model, that unfortunately doesn't fit very well for the architecture of the South African economy as it stands right now.
Haven't we already seen that fallout? We see iron ore prices plummeting. We've seen the platinum price pull back very, very sharply. Or is there worse to come, Mohammed?
Well, it really does hinge on what your view is on the US dollar. Because remember, the US dollar is the corollary, I guess, to commodity prices.
And that can't possibly last.
Well, the US dollar, if you look at it on a technical basis, has potentially another 20% worth of upside to come through. So if that doesn't materialize, you've got pricing pressure as well as volume pressure coming through in terms of commodities. And it's certainly why I think South Africa needs to think beyond digging stuff out of the ground and putting it on ships and sending it overseas. We've got to start looking at more value-added enterprise.
Guys like you have been talking this particular line for 20 years. And nobody's listening, Mohammed. Give me a view, please, on the US dollar, because we look at the resurgence of the US dollar against the backdrop of, you talk about the Chinese debt burden. You guys have got your own amount of debt as well, sitting in the teens of trillions of dollars. When we consider interest rates in the United States and the reluctance of the US Fed to raise those rates for fears that it will negatively impact your economy, just give us a sense for the future of the dollar.
I've been looking at the US dollar for over a year and expecting a breakout. So what we're seeing on the US dollar is that the US economy is moderately stronger than most of the rest of the world. It's as much of a boom as you can expect in this type of a global economic environment. And all the data right now does justify a Fed rate hike. It's important to note that the dollar can rally on a few different factors. It can rally because the U.S. is so much stronger than the rest of the world. That argument may last for a little while longer, not for a terribly longer. But if the Fed goes ahead and hikes rates today, the yield differential on our 10-year bonds, for example, and shorter-term bonds, compared with the rest of the world, especially a lot of emerging markets where investors have been scrambling for yield, that's going to widen. And as that widens, I think you could see the US dollar rise 10, 20, maybe even another 30% from here. Now, that kind of a rapid uptick in the US dollar is likely to increase the burden of dollar-denominated loans on a lot of emerging markets, and it could start kicking off risk aversion. What we think of in emerging markets, South Africa, unfortunately, being one of the most vulnerable, is that if the dominoes start to fall, if South Africa, if Turkey, countries like Brazil start to get in trouble, the ripple effect could trigger a wave of global risk aversion. That pushes the dollar higher, it pushes commodities lower, and that is a very vicious cycle.
Worth W, Ray, I'm going to let you go, co-author of A Great Leap Forward. I'm going to let you go simply because the Skype line is going to let us down sooner or later. I don't like your friend, Worth W, Ray, Mohammed.
Because he's bearish.
Because he's telling us some very uncomfortable home truths.
Very much so, and it's why I like talking to him, Bruce, is because sometimes we sit too close.
Yeah.
And we look at this and perhaps our lens is blurred because of that. Worth is one of the more bearish people I know on emerging markets. I tend to agree with him on the medium to longer term. In the shorter term, I think emerging markets have had a terrible 3 months. I think you might get some short-term reprieve. But remember, that Fed hike is looming. I mean, I've been of the view that the Fed's going to start hiking, and that is a structural shift in terms of how markets have functioned over the last 8 years.
So the Fed starts hiking. The South Africa's Monetary Policy Committee voted 4-2 in favour of keeping rates flat at the last MPC meeting. They meet again in July. They're going to raise rates even by 25 basis points. But if, in the meantime, Janet Yellen does raise rates, as Worth suggests she might, suddenly we've got to start playing catch-up on the rate cycle. Otherwise, this rand goes to hell in a handbasket, and it's game on.
Yeah, a lot of people don't understand why the Reserve Bank would be compelled to hike in that particular context. Is that the rand, in theory, would weaken, and through the transmission mechanism, that's inflationary. That's the Reserve Bank's mandate. I really think that the Fed has the scope to, well, now it's at the September meeting. I think the SARB would be loath to preempt the Fed, so I think they'll follow them. The SARB meeting is a week after the Fed meeting in September. But as you correctly mentioned, they will then be compelled into a hiking cycle, despite the fact that growth continues to look so poor locally, and that is is a stagflation scenario.
Completely. And stagflation, of course, stagnant
policy
economy,
impasse.
Stagnant economy, and inflation. You're going backwards no matter what you do.
Unfortunately. And so that's why I certainly am quite concerned around the prospects for the rand, around the prospects for South Africa as an economy, but emerging markets in general. We're not alone in this. And
I don't care that we're not alone. I don't live in Brazil or China. I live here.
Hopefully not this year, but next year, Bruce, your overseas holiday is going to be considerably more expensive.
I ain't going overseas ever again at this rate. I spent some time overseas this year, and my personal habits cost me a lot of money when I go overseas. Give me some optimism. Based on these scenarios, I mean, we know Brazil's in all kinds of bother. It's got the World Cup coming up. It's got big economic problems there, and we've often wanted to keep up with Brazil. China's our best mate. We don't make enough stuff that other people want. We are so far behind.
So you're looking for optimism, and the fact of the matter is some people will tell you maybe you need a crisis to catalyze a shift in terms of policy thinking, in terms of getting things back onto the right track. Whilst we're not the worst in the emerging markets basket by a long shot, and we don't have the extended debt levels that some of these developed economies have, we're still heading in the wrong direction. I mean, there's a whole paper on structural reform and what we could do right. It's not beyond us, and I continue to believe it's not beyond the capabilities of South Africa, civil society as well as government to get this on the right track. But unfortunately right now, a couple of talks that are happening, but not enough action.
Mohammed Nalla, thank you very much. Also on the line to us from the United States this evening, Worth W. Wray, the co-author of a book called A Great Leap Forward. He's a global macro strategist and bearish on emerging markets. Mohammed Nalla, head of strategic research at Nedbank Capital, was with us in studio this evening as well, and is feeling a little bit green around the gills as to broad emerging market prospects, but particularly about our home turf, South Africa, where the currency is vulnerable and where markets too are pretty vulnerable. Terrifying. There'll be more tonight, tomorrow, if we survive long enough. Till then, good night.